Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Commodities ETFs make investing in raw materials like gold, oil, or wheat simple and accessible. Instead of buying physical barrels or bushels, you get exposure through a single traded fund. One popular example is DBC, Invesco DB Commodity Index Tracking Fund, which spreads risk across multiple commodities. These funds are gaining traction as investors look for ways to hedge inflation and diversify beyond stocks and bonds. Whether you're new to commodities or refining your portfolio, understanding how ETFs like DBC work can help you invest smarter. Understanding Commodities ETFs. Commodities ETFs simplify investing in raw materials by packaging them into tradable funds, giving you exposure without handling physical goods. They track everything from oil and gold to soybeans, making them a flexible tool for diversification. Let's break down how they work, their advantages, and what to watch out for. What are commodities ETFs? Commodities ETFs are exchange-traded funds that track the performance of physical commodities or commodity futures contracts. Instead of buying barrels of oil or bushels of corn, you buy shares in a fund that holds these assets for you. These ETFs typically fall into four categories. Energy includes crude oil, natural gas, and gasoline. Metals include gold, silver, copper, and platinum. Agriculture includes wheat, corn, soybeans, and coffee. Broad-based funds like DBC spread exposure across multiple commodities. They're ideal for investors who want commodity exposure without the hassle of storage, delivery, or futures trading. How commodities ETFs track underlying assets. Most commodities ETFs don't hold physical goods. Instead, they use futures contracts, agreements to buy or sell a commodity at a set price on a future date. Here's how it works. The ETF buys futures contracts tied to a commodity like oil or gold. As prices fluctuate, the fund's value changes accordingly. Before contracts expire, they're rolled over to new ones to avoid delivery. Some funds, like gold ETFs such as GLD, do hold physical assets, but most avoid this due to storage costs. Benefits of investing in commodities ETFs. They offer several advantages for portfolio diversification. Commodities often rise when inflation does. You don't need large capital or physical ownership to enter the market. ETFs trade like stocks, making them easy to buy and sell. They don't move in sync with stocks or bonds, reducing overall risk. For example, DBC provides broad exposure to energy, agriculture, and metals in a single trade. Risks associated with commodities ETFs. While convenient, they come with unique risks. Frequent contract rollovers can lead to losses if futures prices are higher than spot prices, known as contango. Commodities can swing sharply due to weather, geopolitics, or supply shocks. Some ETFs don't perfectly mirror commodity prices due to fees or management strategies. It's important to understand these before jumping in. While they add balance to a portfolio, they shouldn't dominate it. Popular commodities ETFs. Spotlight on DBC. If you're looking for broad exposure to commodities without picking individual sectors, DBC, Invesco D Commodity Index Tracking Fund, stands out. This ETF wraps multiple raw materials into a single trade, blending energy, metals, and agriculture for balanced risk. Let's explore how DBC works, what's inside it, and how it stacks up against similar funds. Overview of the Invesco DB Commodity Index Tracking Fund, DBC. DBC tracks the DBIQ Optimum Yield Diversify Commodity Index, which focuses on futures contracts for 14 heavily traded commodities. Unlike funds tied to a single resource, DBC spreads risk across energy like crude oil, metals such as gold, and agriculture including corn and soybeans. Key features include liquidity that trades like a stock with solid daily volume. It offers diversification where no single commodity dominates the fund. Invesco's management automatically rolls futures contracts to avoid physical delivery. It's a go-to for investors who want simplicity while hedging against inflation or market downturns. DBC's holdings and sector allocation. DBC's portfolio shifts slightly over time, but energy typically takes the largest share. Here's a rough breakdown of its recent allocation. Energy is around 55%, including WTI crude oil, Brent crude, heating oil, gasoline, and natural gas. Metals are around 25%, including gold, silver, aluminum, and copper. Agriculture is around 20%, including corn, wheat, soybeans, and sugar. The fund rebalances annually and adjusts contract weights based on market conditions. This helps it stay relevant without requiring constant manual adjustments from investors. Performance analysis of DBC over time. DBC tends to thrive during periods of rising inflation or commodity shortages, but lags when markets favor stocks or bonds. For example, in 2020 to 2020, it jumped during the post-pandemic recovery as oil and metals surged. In 2014 to 2015, it dropped sharply during the oil price crash. Over the long term, it generally underperforms stocks over decades, but adds stability during crises. Fees at 0.85% annually and contango from rolling futures at higher prices can chip away at returns. Still, it's a straightforward way to bet on commodities as a group. Comparing DBC to other commodities ETFs. DBC isn't the only broad commodities ETF, but it's one of the most traded. Here's how it compares to alternatives. GSG, the iShares S&P GSCI Commodity Index Trust, is heavier on energy, especially oil, making it more volatile. QMB, the Granite Shares Bloomberg Commodity Strategy ETF, has lower fees at 0.25%, but is smaller and less liquid. PDBC, the Invesco Optimum Yield Diversified Commodity Strategy. No K1 ETF is similar to DBC, but avoids K1 tax forms, simplifying filings. If you prioritize diversification and liquidity, DBC holds an edge. But tax-conscious investors might prefer PDBC, while cost-focused traders could lean toward COMB. Strategies for investing in commodities ETFs. Commodities ETFs like DBC offer more than just exposure to raw materials. They're tactical tools for building a resilient portfolio. Whether you're looking to spread risk, protect against inflation, or tap into long-term trends, these funds can play multiple roles. Here's how to use them strategically. Diversification through commodities ETFs. Commodities often move independently of stocks and bonds, making them a natural diversifier. When equities slump due to economic worries, assets like gold or oil might hold steady or even rise. DBC, for example, spreads your investment across energy, metals, and agriculture, reducing reliance on any single sector. That's it for Part 1. We've covered the basics of commodities ETFs and their benefits. Stay tuned for Part 2, where we'll go deeper into how to invest smartly in ETFs like DBC. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.